What is interest? Welcome to Money and Good Sense. Almost everyone has to deal with interest on a savings account, with a mortgage, or when borrowing money. But what exactly is interest? Why does interest exist? Who determines the interest rate? And why does interest have such a big impact on the economy? That is what we will look at in this video. What is interest? Interest is basically the price of money. Just as you pay rent when you temporarily use someone else's home, you pay interest when you temporarily use someone else's money. Suppose you borrow $10,000 and you repay $10,500 1 year later. Then $500 is the interest. So interest is the fee you pay for temporarily borrowing money. But why does interest exist in the first place? Why would anyone lend money if they received nothing in return? There are three main reasons why lenders would not lend out money. First, the lender cannot use that money for anything else during the loan period. Second, there is always the risk that a loan will not be repaid in full. And third, inflation often causes money to lose purchasing power over time. In the future, the same amount of money will usually buy less. Interest therefore compensates the lender for temporarily lending out money, for the risk that the loan will not be repaid, and for the loss of purchasing power caused by inflation. Who determines interest rates? No single person determines interest rates. Banks decide for themselves how much interest they charge on loans and how much interest they pay on savings. However, they do take the central bank's interest rate into account. When the central bank raises interest rates, it usually becomes more expensive for banks to borrow money. As a result, mortgage rates and other lending rates often increase as well. When the central bank lowers interest rates, the opposite usually happens. This is how interest rates affect the entire economy. Why is interest so important? Interest affects much more than just a loan. When interest rates are low, borrowing becomes cheaper. As a result, people are more likely to buy a home, and business invests more quickly. When interest rates are high, the opposite usually happens. People borrow less. Businesses invest less. As a result, economic growth often slows down. Interest is therefore one of the most important tools in the economy. Conclusion. So interest is basically the price of money. Those who borrow pay interest. Those who lend receive interest. And because interest affects savings, borrowing, investing, house prices, and economic growth, it plays an important role throughout almost the entire economy. In future videos, we will take a closer look at mortgage rates, the central bank, and how interest affects the housing market. For now, thank you for watching. Did you find this explanation interesting? Then subscribe to Money and Good Sense. And remember, don't worry too much. Everything can be overcome with study and patience.